Hey folks, Shawn Plummer over at the Annuity Expert. In today's video, we're going to talk about how to squeeze the most out of today's fixed interest rates utilizing basically a MYGA ladder instead of a CD rate ladder. The goal here is just to how to ladder multi-year guaranteed annuities for maximum interest rate arbitrage. If you're trying to squeeze every ounce of interest out of today's interest rate environment, but you're absolutely refuse to take on market risk, you really need to take a look at laddering multi-year guaranteed annuities. We call MYGAs. This isn't just some financial theory. This is exactly how disciplined investors turn fixed rates into a highly flexible rolling system for income and growth. Today, I'm going to walk you through how to use staggered annuity terms to beat CD rates, protect your principal, and basically keep your option open over the long term. So, what's a MYGA ladder and why it works? Okay, so for those of you that don't know, a MYGA is basically the annuity version of a CD. You buy a fixed term, guaranteeing a fixed interest rate for that term. At the end of the term, you take the money, you reinvest it, pocket it, cash it in, whatever. The big differences between a CD and a MYGA is CD's taxable interest, MYGA is tax-deferred interest, so you get that triple compounding. And MYGAs are really meant for folks who are saving for retirement or are near retirement or in retirement, right? So if you're like 20 years old and you're looking at CDs, which I don't know why you would, but if you did, MYGA, I would go with the CD over a MYGA in your 20s, in your 30s. But if you're in your 40s or higher and you're using this to invest money, whether that's IRA money or old 401k money or cash, and you want just the guaranteed interest rate because sensible folks want a safe part of their portfolio. So they have it divvied up over conservative, moderate, and aggressive investments. The MYGA fits perfectly in the conservative part of the portfolio because they almost always have better rates than CDs, which right now is between 5 and 6% on MYGAs is what you can expect. And for moderate, folks usually get bonds. We recommend fixed index annuities for the moderate part because you don't lose value in your annuity and you're able to get it above the average rate of returns. And then they're in the market for the aggressive part of their portfolio. So anyway, getting back to the MYGA ladder. So first, what are we actually talking about here? A MYGA ladder simply means you're splitting your money across multiple fixed annuities with different term lengths instead of just dumping it all into one single contract. Think of a MYGA like a CD, like I mentioned before, but typically with higher yields and tax-deferred growth. When you ladder them, a few incredible things start to happen. Number one, you avoid rate lock regret. You're not committing to all your cash into one single interest rate. Also, you're also mitigating your risk even further. Most of these annuity companies, no, all of these annuity companies have to fund a state guarantee association. And that's the insurance industry's version of the FDIC. So, if if an insurance company becomes insolvent and goes out of business, which is very, very rare, way more rare than any bank or credit union, that the state guarantee association would cover the contract terms and conditions of your annuity. So splitting it up already amongst multiple companies just adds another layer of security and a safety net in case of a business goes out. So it's usually around $250,000 to $500,000 that the state will meet if the company goes out of business. So that aside, this is also another reason you aren't committing all your cash to one single interest rate. Although, with that said, with today's interest rate environment, we're at the highest interest rate environment since the 90s. So I would go longer, higher interest rate. By the time you renew your interest rate, it's going to most likely be at a lower interest rate, where right now it's 5 to 6%. You could expect probably 3 to 4% once your MYGA renews. Another reason why you would do a MYGA ladder is you create scheduled liquidity. As each contract term matures, cash frees up. And you can just keep it in the annuity on some contracts. Some they'll automatically renew you for another term, so you want to be careful of that. You also get reinvestment power. You can reinvest at potentially higher rates down the line. I don't think that's going to happen as of 2026. I think it's going to be by the time the MYGA is over, I think it's going to be at a lower interest rate environment. Just for anybody listening to this, know that right now with annuities, the interest rates are higher and the annuity payouts are higher. So where normally you would get, 5 to 6% payout, you're getting anywhere from 7 to 10% payout. So it's a no-brainer if you're using annuities for your retirement income. Let's say you reduced timing mistakes. You aren't making a single massive bet on what the economy will do today. So, once again, you're just mitigating risk and you're just hedging your bets along with, giving a higher probability that you are able to make a successful outcome over a longer period of time. Okay, so the traditional ladder is usually a 2 to 5 year stagger. A 1 to 5 year stagger. Basically, you split your money across 1, 2, 3, 4, and 5 year MYGAs. We have one 1 year MYGA, and it's with a B-rated company. So if you want to go that route, you can. Your next best thing is a 2 year MYGA with a good company and a good interest rate. So I would probably start with a 2 year MYGA to stagger off, and then you can do 3 year, 4 year, 5 year, and so forth. But once again, we're in this weird period where you can get 5 to 6% up to 10 years in length. That hasn't happened in the MYGA world since the 1990s. So it's take advantage of the long term, because if you're going to do this strategy, you get a 2 or 3 year annuity where it might give you 5%. It's probably going to be around 3.5 in 2 to 3 years, assuming everything corrects itself. Okay. There's the barbell strategy. With the barbell, you ignore the middle. You split funds between short-term 1 to 2 year MYGAs and a long-term 5 to 10 year MYGAs. Reason why you would do that is you capture the high yields of a long-term contract while keeping some cash easily accessible in the short term. Most of these MYGAs have liquidity provisions where you can pull out certain amounts each year, like typically up to 10% of your account value each year without some sort of penalty. So keep that in mind. The catch, there's a gap in the middle where nothing matures. Who's it for? This is for investors who think rates might rise soon, but still want to lock in some high long-term yields right now. There's a bullet strategy when doing ladders. This is where you buy multiple MYGAs, maybe at different times, but they all mature on the exact same date. You're going to get this massive predictable lump sum right when you need it, like for retirement income, or maybe you want to buy a house. There's little liquidity until that specific date. It's usually, like I said, interest only or up to 10% each year. This is for planners who want a very specific future cash need. So they are planning for their future date to get this large amount of money. The rolling ladder strategy, which is basically perpetual reinvestment. Here, every time a MYGA matures, you automatically reinvest into a new long-term contract, usually 5 to 10 years out. This maximizes your long-term yield potential and builds a self-renewing portfolio that smooths out interest rate cycles. It requires a lot of discipline, and your money's always going to be partially locked up. But for savers, long-term savers who want consistency in market-free growth, this could be a solid. You spreadsheeters out there. We talked to some folks that create their own spreadsheets, and then they're trying to perfect it. It's almost like an artist painting a painting. These spreadsheeters, they are looking at it and they are trying to create their ultimate retirement dream. Next strategy is the income ladder. This is when you're transitioning to lifetime income. I like this strategy. Finally, your ladder MYGAs today grow your base. And as they mature later, you roll them into an income annuity or a fixed index annuity with a guaranteed lifetime withdrawal benefit. You're going to maximize growth now so you can secure a much higher guaranteed lifetime pension later. You're intentionally delaying the income. This is perfect for pre-retirees who are in the critical critical final years of building future income. Okay, so what that means is, hey, let's say you're 50 years old, you want to retire at 60. The markets are volatile right now. I just want to take it, earn a fixed interest rate, 5 to 6%, and then when I turn 60, I want to take a lifetime income. That could work, but I think you could do better by buying a fixed index annuity with a guaranteed lifetime withdrawal benefit and letting it defer, because with the guaranteed lifetime withdrawal benefit, it's the name of the game with those things are the longer you wait before starting income, the higher the payout. So most people think it's age, but it's really the length of time between the day that you purchase the annuity and the day that you start the lifetime income. The longer you wait, the higher the income. That's really the name of the game. The other in this situation is if you've been pitched a DIA, a deferred income annuity, which is not a lifetime income rider. It's basically the irrevocable version of a SPIA, but for the future. Basically, you give a lump sum of money to the insurance company, and then it becomes their money, and then they, in return, gives you a future income for a fixed period of time, or income for life. Sorry, I'm a little slow today. Using a MYGA and then taking an income is probably a better bet than doing the DIA. I'll give you an example of a client I just talked to. So I had a guy who's like 51 years old. He had $250,000. Was going to go into a DIA, and in about I'm going to say 5 to 7 years from now, and then take a 10-year period certain. Basically, he's trying to build the gap for his lifetime income at age 67. And my thought was like, why would you put a DIA off of $250,000 and guarantee your income, your future income today, when you could just take that same $250,000, put it in a MYGA, grow at 5 to 6% a year, and then annuitize the contract, because every annuity gives you the opportunity to annuitize the contract. And then he wanted to do a 10-year period certain. So what it essentially happened was he was going to take $250,000, buy a $250,000 DIA, and then he was going to get a 10-year period certain. And a 10-year period certain is just taking your $250,000, paying it back to you over a 10-year period with a little bit of interest, maybe 1 to 2% in interest, okay, baked into that payment. And then after that 10-year period certain is up, the contract's done, okay? Well, my thought was like, well, why don't you just take the $250,000, put it in like a 5-year MYGA and earn 5 to 6%, and then annuitize it and take a 10-year period certain. So, and this guy worked for a major accounting firm, and he was like, I didn't even think about that. And what the end result was, instead of taking a 10-year payout of $250,000 with interest, he was taking a 10-year payout off of $312,000 plus interest baked into the payment. So accomplished the same thing, but he got a higher income just by doing that tweak. So that's kind of the idea of MYGA laddering. Basically, the arbitrage reality check is you're not going to outsmart the market. When you're comparing investing in the market to a fixed interest rate, you're always going to lose in terms of upside. So just know that. But what you're trying to do is lock in today's higher rates on longer contracts, while keeping shorter contracts handy just in case rates go up. You're averaging your entry points. The whole point of this eliminates the biggest mistake that I see, which is folks who are like just putting all their money in the market like 5 to 10 years before retirement and hoping for the best. And then a 2008, 2009, happens where a lot of pre-retirees had to end up working 3 to 5 years longer just to make up for the loss that they took in 2009. So just keep that in mind. If you're ever shopping for a CD, know that you could do better with a fixed annuity. You're actually getting better terms than a CD because you're going to get liquidity in a lot of cases. You're going to get triple compounding on the tax deferred growth. The interest rates are higher. And death benefit's the same as a CD. Lump sum goes down to beneficiaries. A lot of times, the MYGA death benefit avoids probate and the estate and goes directly to the designated beneficiary, kind of like life insurance does. So it's better. It's a better strategy to go. So come to the Annuity Expert. Just go to your favorite search engine, type in the Annuity Expert. We'll show up. And then you're going to go up here, fixed annuity rates. We have a human being update this every single day. We pay them to do this. As you can see, April 23rd, that was yesterday. And then we're going to show you all the best 2, 3, 4, 5, 6, 7, 8, 9, 10 A-rated companies. Then we're going to show you what the highest rates are regardless of rating. As you can see, most of them are B-rated, which we don't recommend. But hey, it's your money, not ours. And then we have a table kind of showing how long the company's been around, their liquidity, what the rate is. And then you can just give us a call. Call us at 770-755-1565, and we can give you a free quote, no obligation. And then leave a comment below. If you have a question and you don't feel comfortable contacting us yet, leave a very specific comment, and I will answer it within the next couple of days. Hope this helped get your brain juices going on what you could do, especially for those of you who are nearing or in retirement. And then we can give you some solid advice by contacting us. See you on the next video.